And now we are going to start again with our third panel, which is again going to be moderated by Mauro Guillén. And the next panel discussion is titled, "Is Foreign Capital Returning to Spain? The Perspective of International Investors." And as I mentioned before, will be moderated once again by Mauro.
How come that although the Spanish economy is not fully out of the crisis, there seems to be actually quite a bit of capital flowing into Spain? So is this a good omen? Is this something that is anticipating that the future is actually bright for the Spanish economy? Those are some of the issues and the questions that we're going to be addressing on this panel. First, we're going to hear from Ignacio de la Torre, who's a partner at Grupo Arcano. Grupo Arcano provides advisory services and has a wealth of experience playing that role in the Spanish economy and beyond. And I'd like to start the conversation with you, Ignacio, by asking very briefly, this morning we saw that the forecasts for the Spanish economy are getting better and better and better. And actually, only 48 hours ago, or a few days ago, the European Union mentioned that in the year 2015, it is expecting Spain to grow by 2.1%. So what's driving this, in your view, this improvement in forecasts?
Okay, on one hand, as you know, the economic predictions make astrology a respectable science. And the reality is that I don't think the market is basically making their assessments based on the consensus of economists, but basically following the patterns of activity. That basically means looking at the PMIs, Purchasing Manufacturers Index, which if they are above 50 is good, they are below 50, that's bad. So Spain was at 43, 44 a year and a half ago. We are not 54, with China being 49. And the thing is that now Spain seems to have very strong activity indicators, which points towards the fact that we'll be ending this year with growth, which could be even above that of the Eurozone. On the other hand, the employment situation is changing a lot. I'll give you one data. Last Friday, you had a terrific jobs report in the US. You have created 288,000 jobs in March, which was a very good data. Spain yesterday got the payrolls data. We have created 154,000 jobs. More than 50% the ones created in the US, but our economy is only 8% the size of that of the US. So something is changing on the job market, and this is obviously impacting positively consumption. And finally, exports. Now, if you look at the 196 countries in the world, Spain got the second largest growth in the world, only after that of the UK. We grew our exports 7% last year, despite being a difficult year. We are already exporting 35 points of GDP, which is above those of the US, France, Italy, or the UK as a share of GDP. And despite having this huge exporting base, we are still expanding it at 5% this year. So the three drivers together explaining why economies have to move upwards their forecasts.
Okay, so Ignacio, I'm reading my notes here, and in October of last year, you made two calls. So the first one was that the country, Spain, was turning the corner from the point of view of funding itself. And then the second one was that internal demand, domestic demand, was about to recover. So could you give us an update on those two projections that you made at the point?
Yeah. People thought that we were crazy because of pointing towards these two indicators, as they thought we were crazy when in October 2012 we recommended investing into Spain. And the thing is that last fall we said, look, the credit situation is about to change. And what you should be looking if you want to forecast the economy is new credit. It's not the stock of credit, but new credit. This is what drives GDP. And actually the funding situation of banks had improved a lot, also the solvency situation of banks. And there is an increasing factor, which is shadow finance, non-bank finance arriving to Spain very aggressively. And the three put together, we're about to change. Now, since November, we know that credit to the private sector, new credit, is up 8%. And this is basically explaining why GDP is beginning to react very positively. And companies are issuing bonds at record levels. And obviously, all this liquidity floods into the economy, and the economy reacts. As for internal demand, the situation is that we have been seeing levels of consumption and investment which are ultra low. For instance, Spain is investing only 17 points of GDP compared to a long-term history of 22 points. Or in consumption, last year we sold only 0.8 million cars, more or less the same as we used to sell when Franco died. This doesn't make any sense. When people stop being afraid of losing their jobs, they start to reactivate the consumption functions, and this has begun to happen in Q4. And as for Q1, we are beginning to see how consumption and investment are picking up, and this is driving GDP upwards.
Okay. Now, last question for you, asset prices. So asset prices in Spain are growing quite fast at this moment. So foreign investors thinking about buying assets in Spain, where's the value for them at this point moving forward?
I think that the major risk in Spain is overcrowding. Too many investors coming into the same asset classes. And it is true that in many traditional asset classes, you cannot get very high returns. I'm talking of large equities, I'm talking of government bonds, even corporate bonds. So investors need to scratch their heads and to look into very different strategies. For instance, we have advised two hedge funds to do a direct lending transaction of 85 million euros, lending into a Spanish water company. And this was yielding 11.85%, 13 years loan, non-callable. And this is kind of a transaction where you can extract a high yield if you really put your work into it. Also, we have advised the Spanish government into creating a local high yield market by which medium-sized companies can issue bonds. It's called the MARF. And this has allowed companies which were not able to issue bonds in the past to issue these bonds. So we have been placing two bonds yielding between 7.5% with ratings between B and BB. And this is another opportunity to extract yield, because in traditional high yield, you cannot get yield. It's now low yield. And finally, on the equities world, you need to go into small names which don't have any good research coverage. And that's where you can find plenty of value of nice industrial companies which export a lot and who should also benefit from a recovery of internal demand. For instance, a year ago, we placed 60 million euros in a small cap called Michele Costas, which is a cigarette manufacturer of the paper surrounding the cigarette. We played the 60 million euros and the stock went up 40%. And this kind of names, as they don't have much research, this is where you can really find plenty of value on yields.
Thank you, Ignacio.
You're welcome.
So our next guest is Bruce Kasman, and he has a very important position at JP Morgan. He's the chief economist and head of global research, and he's the main thrust behind a very important publication, Global Data Watch, which I highly recommend to all of you. So you write pretty much every week about the interplay between growth and deflation at the present time. And I guess the question that everybody in the audience here would like to know about, in terms of your perspective on it, is how do you see the relationship between those two things evolving in a country like Spain?
Right, and I'm going to talk about Spain as somebody who looks at the global economy and thinks about Spain in the context of what's happening more broadly. And I would just say that the way we're putting Spain together right now is we think Spain is bouncing towards malaise. And I think we should recognize and appreciate the bounce, and we should also recognize and appreciate the challenges that lie ahead, of which I think the low inflation, possibly deflationary dynamic is an important indicator and highlight of what those challenges are. I want to just start by recognizing why we are in the place where we are today, thinking more positively about Spain. And I want to emphasize two things that have happened over the last 18 months. We have fixed a flaw in the euro area, which did a lot of damage to Spain, and we have, I think, corrected a misperception. And that's had a big impact on the Spanish economy, and it's having a big impact on financial flows, attitudes towards Spanish assets. What's the flaw? We started a monetary union with a Maastricht Treaty, which had a 60% of debt to GDP ratio. Implicitly, we assumed a sovereign in the euro area was like a sovereign everywhere else. Spain was like the United States. We went through the first 10 years basically with that in mind. The Greek crisis came, and the ECB and European policymakers then behaved as if Greece, as if Spain, if Italy were like Illinois or California. You can't run 60, 80% debt to GDP ratios if you're a state and you don't have a sovereign backstop, and that caused enormous financial stress. It raised solvency issues that didn't need to be raised, and obviously we can understand the damage it did to the banking system. The fatal flaw was fixed with the OMT program in the fall of 2012, and a lot of what we're seeing happening in Spain, in financial markets, in the euro as a whole, stems from what was fixing that flaw. The second thing that I think happened is we began to understand the misperception that was created as the crisis intensified that not every country on the periphery of Europe is Greece. The perception that began to be put into the picture was that every country on the periphery of Europe was profligate and was sclerotic, and that therefore huge adjustments, big policy changes were going to need to be made to get these countries back to growth. I think Greece has got a lot of those elements to it, but I think if you look at Spain, Italy, Portugal, these are very different countries, very different sources of crises. The Spanish situation, and I know I'm way oversimplifying, is an asset price bubble that created a banking and housing boom in the aftermath of monetary union. Huge damage done as a result of it, but the Spanish private sector, at least when viewed in the European context, is not sclerotic. The Spanish government was not profligate. And I think once we got through the fixing of the fatal flaw, we began to see the potential dynamism adjustments take place in the private sector, helped by some reforms, helped by policy adjustments, and we're beginning to see growth come as a result of those two things coming together. However, Spain has huge overhang problems in its financial sector. It has an output gap that we would estimate at close to 10% of GDP, and put in comparison, our estimates for the U.S. are less than half of that. And that is being reflected, I think, right now, even as we're growing. And by the way, we think Spain is going to outgrow the European average from the second quarter of this year onward. We think growth this year is going to average about 1.5%. So I think I'm quite upbeat about the near-term growth outlook. But think about in the context of a 10% output gap of an economy that 7, 8 years ago we thought could grow 3%, what a 1.5% growth number means. That's not very much. And that's being reflected right now in the fact that Spanish prices are not rising, and that there is a legitimate risk that Spain experiences deflation. What are the things you need to complement the adjustments taking place in the private sector? You need support from policy and domestic demand. We obviously don't have that lever available on the fiscal side, and we have a problem that we have an ECB which is not putting enough weight on the periphery and Spanish slack in terms of setting monetary policy. And this is going to be an overhang. It's going to be a problem that is going to make things a lot more difficult, even recognizing all the good things that we can see when we talk about Spain coming out of recession right now.
So you just touched on the topic of my second question, which is the European Central Bank doing enough to support the incipient recovery in Spain? So your answer was no. So then my follow-up question, of course, is what do you believe the ECB should be doing to support the recovery in a country like Spain?
Well, the ECB's got a responsibility for setting policy for the entire region, and it needs to maintain that. But inflation in the area today is 0.7%. That's well below the objective. I think what the ECB needs to come out and tell us is that it cares about getting inflation back to its objective soon. It's committed to acting in that direction. And I think that would be very helpfully complemented by a clear set of forward guidance metrics. I would argue that they should say that because of the amount of slack in the region and because of how low inflation is, they probably shouldn't be thinking about tightening policy till the unemployment rate in the euro area gets down to about 9%. The euro area unemployment rate today is 10.8%. So we can see, excuse me, it's 11.8%. So we can see how far you'd have to run there. I think complementing that with some targeted asset purchase plan would be supportive of that. And I think the dynamics of that through currency, through helping financial conditions would be supportive. It wouldn't be a panacea. It's not the only issue you have to face in terms of generating stronger demand. But the ECB's got a role to play for the region. And I think implicit in the ECB's unwillingness to be more aggressive is an implicit judgment that the damage done to the Spanish economy over the last 5 or 6 years is structural. And I think that's a mistake. And I think if it's followed through over time, you will see a Pyrrhic victory being won, which is that weak demand will generate hysteresis and weak supply in a way that judgment will actually turn out to be true, but for the wrong reasons.
Yeah, and we don't like any kinds of Pyrrhic victories because those sound too Greek to me, right? So now the last question very quickly is what should be the role of fiscal policy? Do you have any views on that you'd like to share with us?
Well, I think that's the other side of the Spanish story, which you have to be somewhat more sober about. If you look at the performance of the economy this year, one of the big things supporting us is that in 2013, our estimates are that the fiscal drag on Spain from a demand point of view was close to 3% of GDP. This year, it's less than 1% of GDP. It's a big swing factor supporting the recovery. Going forward for the next 2 years, the government has no real plans to accelerate fiscal adjustments, but it has a forecast that has the primary position of the Spanish economy improving by 3 percentage points. To get those two things together, I think you're going to need more than 1.5% growth. I think you're going to need a lot more than 1.5% growth. I think Spain's capacity for growth right now is quite strong, and you'd need, I think, 2.5–3% growth to achieve that. So the issue is, do you get the growth? And if you don't get, and you're not going to get the growth through fiscal supports, but if you don't get the growth, you've got a hole in your budget programs, and it is a big issue in a world in which your debt to GDP ratio is going to tip above 100% over the next couple of years. So it's, you know, it's hard to argue you have a lot of room for flexibility there, and it is certainly a concern that you might actually find pressure both on the numbers and also from the European partners in terms of requiring more efforts to be done.
Okay, thank you so much, Bruce. Our last guest is Alfredo Soriano, who is the managing partner, managing director and head of investment banking at JB Capital Markets, which is a broker-dealer. And the first question for you is, your company has helped quite a few foreign investors arrive into Spain and make investments. So how would you describe current trends looking down the road, maybe 3 or 6 months? I mean, what's going on with the arrival of foreign investment into Spain right now?
Well, thanks, Mario. Well, not even 18 months ago, Spain was simply not there. I mean, if you called an investor to propose an investment in Spain, basically they did not pick up the phone. For a company like us, whose 80% of its client base is overseas investors, whose business proposition is to be an entry point of choice to Spain, that's an issue for sure. But hopefully, things started to change very rapidly after the systemic fears about the euro breakage fall apart. We got a first wave of investors that were basically looking to Spanish companies, but heavily internationalized, with, let's say, 60 or 80% of their business out of the country. They're presumably undervalued because they were Spanish, but with the business out there. But then, very rapidly, we have inquiries about companies that could benefit from the recovery of Spain in 2 years, 3 years' time. That were long-only investors that also wanted to take benefit of the low prices and bet on companies with heavily exposed to tourism and consumption, etc. And when you really realize that things were changing, is when they inquired you about stocks that will more than proportionally benefit for recovery taking place earlier than expected. I mean, when the mindset of the investor was already thinking and their investment thesis was starting to be there, is when you realize that things are definitely coming. On the other hand, what happened is that a large part of the shareholder base of many mid-caps and many companies were in the hands of troubled entities, the former savings and loans and over-leveraged companies. And so on one hand, we have a lot of paper coming to the market to be sold, and investors wanting to come to the market. And as you said, we have helped a number of companies to rotate even more than 40% of their client base in less than a year, and basically bring in institutional investors, very big names, people that brings stability and sophistication to the shareholder base of the company. So what we see, it's in the coming months that the trend is that Spain is not a question, and the investors will decide basically on the fundamentals of the companies on one side, and of course of the macro environment. But in Spain is not a question anymore. We've seen also that in the debt markets and also in M&A, in private companies, the inflow of corporates, of industrial companies taking over companies in selected sectors. We have also experienced how companies exiting have performed dual track processes, both an IPO and a trade sale at the same time, running together to see what was the price to be higher. So definitely, I mean, Spain has a lot of challenges ahead, but rising the interest of international investors is not one of them.
Okay, and how about direct lending deals and purchases of distressed assets? So what are what's going on?
What's going on there?
Looking into the future.
Yeah, I think that Ignacio has already pointed out about the shadow banking circumstances. Well, the financial sector in Spain has also a radical transformation. On one hand, the consolidation has wiped almost 2/3 of players, and on the other hand, the remaining companies have been looking internally to their own balance sheets, cleaning them, reinforcing capital, and fostering the business abroad, because that was what the market were valuing, how much of your business was abroad, your own country. In an economy where the vast majority of companies, except for a very, very large blue chips, rely 100% on relationship banks, well, that has an enormous impact, because relationship banks, some are not there anymore, and others, of course, have less availability of credit. That has created room for shadow banking activity. There is a large and increasing number of institutional investors focused on direct lending that have raised capitals in the light of the quantitative easing policies that have dropped dramatically their minimum ticket size, and that's a very good news for the Spanish economy, because the Spanish economy is a small one. I mean, many relevant players are SMEs by international standards. So you could have always performed a tailor-made credit facility for 300, 400, 500 million, but now you can do that for 35, 20, even 10, and that is creating a number of opportunities. This said, it is true that we are perceiving that banks are back. Banks are lending again to eligible companies, to good assets, and a very basic proposition some months ago, which was, I'm giving you credit, banks are not, that has a price. It does not work anymore, at least if you want to get double-digit returns. However, there are a number of situations where banks are not comfortable. For instance, margin loans on private companies, dividend recaps of financial sponsors, things that where there is a very good underlying asset, a very good collateral, but which are, let's say, complex and not obvious for banks. And we are seeing, and we are actually closing transactions in that space. And last, the government has passed a very recent regulation, only several weeks ago, reforming the insolvency processes and taking them closer to the U.S. practices. I think that the effects are yet to be seen, but definitely there are some room for new structures and new trends. For instance, debtor in possession, which is debtor in possession finance is an asset class in itself in the United States. There is a practice was not present in the country, in Spain. However, with the new regulation, they have provided 100% protection for debtor in possession finance over the first 2 years of a company getting out of insolvency, and I think that is creating opportunities. Also, the fact that the new cramp-down provisions or a new regime of responsibility for holdout gamers, I mean, the whole thing around distressed asset is changing, and definitely I think that we will see a number of different transaction structures there in the coming months.
Yes, thank you, Alfredo. I'd like to emphasize one thing, one very interesting connection, I think, between what you just said about insolvency reforms and what Monica de Oriol was saying about the changing culture of entrepreneurship for the better in Spain, which is that, of course, one of the most important obstacles that stands in the way of entrepreneurship is if the cost of failing is very high, right? And unfortunately, until recently in Spain, the cost of failing has been too high. And this insolvency reform, I think, helps lower that cost, and therefore more people are willing to become entrepreneurs. Now, the last question for you would be about real estate. So has the moment come for foreign investors to come back big time into the Spanish real estate sector? Yes or no?
Well, the question is not only if the time has come back. The money is coming in huge amounts to invest in real estate, and I think that I share the views of Ignacio that there's a risk of overcrowding there. Real estate was at the heart of the bubble, of course, but now in different segments, basically commercial premium real estate. The fact that there has not been new stock for the last 4 years. I mean, you cannot see cranes in the skies of Madrid as of today. So there's no new stock coming to the market. There have been very low capex maintenance, so there is room to create value through refurbishment of these assets. And again, banks are back, and they are leveraging again good premium assets. So I think that there is room to create large portfolios of real estate companies, and the regulation about what we call SOCIMIs, which are our REITs, our real estate investment trust, has nurtured and allowed a number of projects that have gone to the market. A couple of them have gone public this early year, and some are underway, and they have been heavily oversubscribed. I think that for investors that are specialized in real estate, they play their own game and they get there. But for those generalists that want to have at least a presence in the recovery of the real estate country, definitely there is no better way than to enter through one of these vehicles. Last week we were in New York marketing one of these vehicles, and the interest was enormous.
Here in New York?
Yeah, here in New York. Yes,
very good. So thank you to our panelists. We have about 8 or 10 minutes for questions from the audience, and there should be a microphone somewhere at the back of the room. Who would like to begin the questioning? Juan, could you bring them here to the, to the front row first? And please, once again, introduce yourselves and then ask.
I'm Juan Inciarte from Banco Santander, and I want to ask Bruce a question regarding monetary policy of the U.S. and how that may affect emerging economies and Europe. Because it's critical. Today we have Janet Yellen. This morning I saw her that is thinking that monetary policy in the U.S. will be a little more ease than people were expecting, because she sees problems in emerging economies, and that may come even to Europe, because obviously at the end of the day markets are so interconnected that obviously what happens in Europe to Spain affects what happens here in New York. So at the end of the day, the dollar continues to be a much stronger currency worldwide than the euro. And I would like to hear that you, since you are a New York bank, what is your expectations on that?
So first, to start, our view on the Fed is that we're well over a year away from when the first rate hike comes in the normalization process, that the economy will do reasonably well, grow at about a 3% pace over the next number of quarters, that labor markets will continue to tighten, and that will, over time, put pressure on the Fed to begin the normalization process, but that inflation is not a problem. It's not a problem in the U.S. To the extent it's a problem in Europe, it's a problem because it's too low, and the EM weakness is adding a new leg of disinflation to the global scene. So that the Fed will be patient here, but patience does have limits, especially as the economy does continue to see labor market tightness. So there is, I think, both the idea that we're a ways away from this adjustment, but not so far away from it that we don't need to recognize that it's coming. We think 2015 will start the year with the Bank of England beginning its rate normalization, and sometime in the second half of the year we'll have the Federal Reserve join in. And then I think your question, which is a really central one, is how do global financial markets and global economies deal with it? I think first and foremost, there's no doubt that the pricing of riskier assets in the world are levered to the policy rate environment, but there is already expectations of some of that adjustment. That said, I think once the adjustment comes upon us, there's going to be a shakeout, and there's going to be some uncertainty that's going to add to turbulence. To me, the bigger question is, where are the vulnerabilities to having lived in such a long period of extremely accommodative policy? And I think what's interesting and what makes this environment so, I think, difficult to make sense of is that while the Fed has been at the leading edge of the easy money story, the U.S. economy has not been at the leading edge of where that has showed up in terms of real activity and in credit markets. So I am more concerned in the initial phases of this adjustment in those countries that have been levered to the U.S. Rate cycle and have very strong, long-lasting credit booms that are still underway, and have had housing markets, have had real activity that has been levered to that. And I think if you look at that around the world, I'm certainly not worried about the euro area or Spain in that, but I do think you have countries in the developed market economies, Canada, some of the Scandinavian economies, Switzerland, Australia, New Zealand, that you want to worry about a little bit here. And I think you have a number of emerging market economies where credit has been very strong in its growth, and you have those issues around allocation of resources. Certainly, I think the Asian economies in EM, if I think about Singapore, Hong Kong, and a few others, are the ones that are probably on the top of my list, recognizing that that's a different story than the countries that are now under pressure because of their macro imbalances, your Brazil, your Turkey, your India, your fragile countries. Now, that's, I think, a story that's playing out now and is somewhat different than the countries that might have vulnerability once the Fed begins to raise rates.
Thank you.
Anthony Thoraco, Fredericks Michael. Another question for Bruce Kasman. Critics of the monetary union never viewed the Eurozone as an optimum currency area. And since inception of the euro, what is your view about progress towards convergence, and what are the implications for the future? This would help determine, I guess, the potential for full recovery or not.
So how many hours do we have to talk about? It's a large area that you're carving out. So I would just start by making two very simple points. Yeah, the euro area is not an optimal currency union, but the project of monetary union is not first and foremost about efficient and optimal current economic structures. It's a political project first and foremost, and I think to some important degree it's about a political project that's designed to change economic structures in a way that makes the region more optimal from a currency union point of view. That obviously engenders a lot of risk when you do that kind of experiment, because you do create tensions. I don't think anybody appreciated how serious the tensions might come with the sovereign debt crisis, but we've seen that play out as the flaws in the system, which many of whom still exist, create potential for serious risk. Ultimately, I think what has to happen over the next 5 or 10 years is we need to see a process of reform on the political side that defines more clearly a political structure that's consistent with a monetary union. Ultimately, we need, and I think one of the panelists in the previous session mentioned this, we need to really see the promise of the single market get realized. It's a huge opportunity, and it's also a huge disappointment right now. And I think beneath the surface, we have to worry that the slow movement of that, which is happening, and the lack of a joint vision, which I would argue particularly between Germany and France is crucial to this progress going forth, really does generate a lot of political risk going forward. I think what the crisis has shown in countries like Spain, in countries like Italy, and even in a country like Greece is how powerful the idea of Europe is. It has not fallen apart, but I think we also understand that if the region doesn't deliver to the citizens good economic performance and doesn't start to realize the promise in economic terms, the political pressures and risks that can build in a chronic way, perhaps without a crisis in terms of economic conditions collapsing. Those are really big risks as we look forward, and I don't think we should ignore them. I don't think we do ignore them. I think everybody in this room who is involved in Spain understands the risks that are actually playing out on that front.
Do you see any flaws in the way in which the distressed assets program has been managed?
Well, that's a tricky question.
2 minutes.
2 minutes. One to think and one to answer. Now, I think that I mean, topic of the panel is foreign investors coming back to Spain, and we are treating investors all the same, and it's not like that. I mean, investors are many kind of investors, and they are specialized heavily by asset class, and definitely there are a number of investors that are specialized in distress. Okay, and definitely they have their own views about how they have been managed. I think that many of them come with a mindset created in the United States, in the insolvency proceedings of the United States, and the way they are handled. Also, the NPL market, the non-performing loans market, which is of very long tradition in the U.S., where the portfolios of loans are homogeneous, are granular, the quality of information is there. I mean, that's something that it's different in Spain. I mean, I think that those who have been at the responsibility of managing those portfolios, Sareb for the real estate assets or the banks for their own loan portfolio, have created a market that was not there. And many of these distressed assets, like the EMPLs, came from the consolidation of companies with non-homogeneous information, non-granular quality information about the assets. And so I think that we are learning down the way, and now there's an industry that is being created with regard to handling distressed assets. But we have all learned a lot in the last 2 years. I mean, the learning curve is there.
Ignacio, would you like to add anything?
Only one thing, which is there is companies in Spain which are solvent but are illiquid. So if you take a top-down perspective, some sectors in the economy, such as cement, is operating at the levels of the Spanish Civil War, which doesn't make any sense. It will recover. So do you allow these companies to fail, yes or no? And some investors said no, and they help them through deals called rescue finance, in which you provide them with enough liquidity for them to survive and to wait for internal demand to recover. And then you can extract the yields based on the loans you've made to the company, and then you get some call options to enhance your yield up to 15 or 20%. And I think there is some specialized funds, and the typical transaction here was Blackstone supporting the Spanish cement company Cementos Portland. And I think this is very healthy for the economy because it provides long-term finance. And what we need is not only a question of having access to finance, but having access to long-term finance, which is a critical issue.
Well, please join me in thanking the three panelists for their comments.